Rahul, a resident Indian, holding 28% of equity shares in a company. So Rahul is a shareholder. He is having 28% shares in a company, meaning more than 10%. So write down greater than equal to 10%. Took a loan of rupees 5 lakh from the same company. Oh my god, loan is taken from the same company, 5 lakh rupees. So if that company is a closely held company and the substantial part of the business of the company is not granting loans and advances, then this loan can be treated as deemed dividend in the hands of Rahul. But it will be treated as deemed dividend only to the extent of accumulated profits. Yes or no? Now, on the date of granting the loan, the company had, on the date of granting the loan, the company had accumulated profit of 4 lakh. Accumulated profit of 4 lakh. The company is engaged in some manufacturing activity, meaning the substantial part of business is not granting loans and advances. Yes or no, sir? So now, is the amount of loan taxable as deemed dividend if the company is company in which the public are substantially interested? If the company is company in which the public are substantially interested, then the loan given by the company will not be treated as deemed dividend in the hands of the company, in the hands of the shareholder. So write down no, no. Such loan not treated as deemed dividend under section 222E. Why not treated, sir? Because the company is not a closely held company. Write down. Since company not equal to closely held company. Okay. Now the second case, they are saying not a company in which the public are substantially interested, meaning now the company, since company is a closely held company, who is giving loan to Rahul, who is having greater than equal to 10% shares in the company. Yes or no? Then this loan of rupees 5 lakh will be treated as deemed dividend. But it will be treated as deemed dividend only to the extent of accumulated profits and not the full amount. Accumulated profits was only 4 lakhs. Will you be able to write down the answer? Don't worry, this type of questions don't ask. Okay. Now, 3.493. This is Mr. B. He bought 100 shares of A Limited. Okay, no? If nothing is mentioned, we'll consider that the shares are unlisted. Okay? Now, 100 shares of A Limited, at what price he acquired? 40 per share. 40 only, no? So total cost of acquisition is how much? 100 into 40 is 4,000 rupees. Total cost of acquisition. This is cost of acquisition, which is nothing but actual cost, 4,000 rupees. Now what is happening with these shares? They are saying that out of these 100 shares, 20 shares are bought back in November 24 at 60 per shares. So out of this 100 now, 20 shares bought back. When did this happen? November 24, no? November 24. Can I say on or after 1/10/2024? On or after 1/10/2024, 100 shares are out of 100. 20 is only bought back. Huh? What was the cost of these 20 shares? 20 into 40. 20 into 40, 800. Hello. So 800 was the cost of acquisition. Against that, how much he is getting? Buyback price 60 per share into 20, 1200. Yes or no? Now pay attention. This rupees 1200, which he is receiving as buyback price, this was his cost of acquisition. Okay. Out of, if this was done prior to 1st October, what would have happened? Tell me. On this amount, the company would have paid 20% tax under 115 QA, and this amount would have been fully exempt in the hands of Mr. B. But since it is happening on or after 1st October 2024, now there is an amendment. Now the company A Limited not liable to pay tax under section 115 QA. This is the first point. Second point, exemption under section 1034A not available to Mr. B. And 3, this entire buyback price, entire amount of rupees 1200 shall be treated as deemed dividend under section 222F. Sure, sir? Pay attention now. Capital gain under section 46A will also be calculated. But to calculate this, FVC buyback price rupees 1200 will not be taken now. FVC has to be taken as nil, because that entire 1200 got taxed under the head IFRS. Yes or no? Now what will be the cost of acquisition of these shares? Actual cost, which is nothing but 20 shares multiplied by 40 per share is equal to rupees 800. Now from nil, if you reduce 800, you will get capital gain or capital loss? Capital loss. Now this loss is long term or short term? Long term. Why? These shares you acquired in, when did you acquire? Not given. But whenever you have acquired, okay, no? Date of acquisition is not given. Oh, it is given in 2020. See, no, 2020. So you acquired these 20 shares in 2020, and they were taken away from you in November 24. 2020 to 24 will be more than 24 months only. So the shares were long term. For that, the full value of consideration will be taken as nil. Cost will be reduced without indexation because the transfer is happening on or after 23rd July. Yes or no? So the entire amount of cost will be reduced without indexation, but the resulting gain or loss will be long term only. So therefore there will be a long term capital loss of rupees 800 here shall be allowed as set off from LTCG only, because long term losses can be set off only against long term gain. I have already told you. If not, then allowed to be carried forward. Did you understand? Now, what is happening about the other shares? See, 1200 deemed dividend. Okay, 800 is your loss. Okay. Number of shares sold in December 25 by Mr. B at 70. December 25. Next year. Not this year. Next year. How many shares? Bought back by A Limited, huh? Price received, sale price. Sale price is how much? 70 into 50 rupees 3500. Now this will be taken as your full value of consideration. Based on this, the capital gain, long term gain of these 50 shares will be calculated. Yes or no? So minus cost of acquisition only I'll do. 40 rupees per share for 50 shares. Rupees 2000. Therefore, long term capital gain will be rupees 1500. Now, did you have any loss? How much? 800, no? And now you have any long term gain? Yes. So against that gain, the loss can be set off. Yes. So set off of long term capital loss of 20 shares, which you calculated under section 46A. Yes or no? How much? Rupees 800. So now only rupees 700 out of this will be taxed. Instead of taxing 1500, we'll tax 700 only. But later on, when you will sell the shares, when you will get the capital gain, from that the loss will be adjusted. But 1200 which you are receiving right now will now be taxed in the form of deemed dividend only. You cannot charge that under the head capital gains. Done, no? What about the balance number of shares? How many shares? Still held by Mr. B. No effect to be given for these shares. Whenever they will be sold, that time the capital gain will be calculated or bought back. Then the effect will be given which we give for the first 20 shares. Same effect will be given that time also. Got it, sir? This type of question can come as a case study, MCQ case study, or independent question can also be asked for 4 to 6 marks like this. Shall we move ahead? Sixth, illustration number 6. They are telling you to determine the tax treatment, discuss the tax treatment only. Okay, no? So whatever interest on enhanced compensation or compensation which you are receiving in this year, how much was the amount? 5 lakhs. Out of this 5 lakh, the interest for 2021 was 1 lakh 50. Interest for 21-22 it is 1 lakh 65. And interest for 21-22 it is 1 lakh 85. So for the earlier years, this interest relates to this year. That entire interest is coming in this year. Will it be taxable in this year? If you follow mercantile basis, then only this year's income is shown. Hello? So any of these incomes relates to this year? No. So you will say that I will not charge any of the interest in this year because I am following mercantile. No. Entire 5 lakhs which you have received in this year will be taxable as income in this year. Whether in that 5 lakh some interest relates to this year, then also taxable in this year. Whether that interest relates to earlier years, then also that earlier year's interest will be taxable in this year only. Sure. So what you will write? You will write this which I have written. Write it down. This is the tax treatment to be given. Write it down fast. Done, friends. Should I move on to the next income? Wait, we are doing interest only. We are doing interest only. But two interests are covered under the IFOS head because it is given in specific charge. Now, can any other interest be charged under the head IFOS because of general charge? Yes. If you have some money and you give that money to me as a loan, and on that loan, if I am giving you interest, is it your income? Yes. Is it exempt anywhere under section 10? No. Can you charge this interest under any of the earlier 4 heads? No, because you are not in the business of giving loans and advances and earning interest income. Yes or no? You are not in the money lending business. So this interest cannot be charged under PGBP. Not even under any other head. So which is the head remaining? IFOS. Because of general charge, it will be taxable under the head IFOS. Will you remember? Sure, sir. Can you see your illustration number 2? come to this part. Okay. Now see, gift provisions. Do you remember gift provisions? So this illustration talks about the gift provisions. Okay, now I'll read the question. Mr. A dealer in shares, received the following without consideration during the previous year 24-25 from his friend Mr. B. See, he is getting these things from his friend. Friend meaning not a relative. Okay. So he is getting these things from the relative. See, if he is getting shares, no. He is a share dealer. If he is getting shares, then gift provisions will not be applicable. Because something which you receive in the form of capital asset only, gift provisions will be applicable. Do you remember? So he is a share dealer in shares. Dealer in shares. So his business is to deal in shares, buying and selling of shares. So for him the shares will be stock in trade. So if he is getting shares without consideration or for inadequate consideration, for him that benefit will not be treated as his gift. Gift provisions will not be applicable if he is receiving shares without consideration or inadequate consideration. Getting my point, everyone? So now what he is getting without consideration? Cash gift 75,000 on his anniversary. Wow. So this year his anniversary is there. On his anniversary he is receiving sum of money which is more than 50,000. Will it be taxable? Yes or no? T for taxable. Okay. Now bullion means jewelry. The fair market value was 60,000 on his birthday. This year only his birthday. So one gift he is receiving in April. This is cash gift. Another gift he is receiving in June. This is also without consideration jewelry. So the value of that jewelry is more than 50,000. This will be taxable fully. Okay. Now next he is getting plot of land at Faridabad on 1st July 2024. The stamp duty value is 5 lakhs on that date. He is getting immovable property without consideration and the value of that is 5 lakh, more than 50,000. So this will also be taxable. Now Mr. B had purchased the land in April 2009. So the person from whom he is getting, Mr. B, his friend, Mr. B had purchased in April 2009. For how much? So the cost is not given. So whatever cost the B had purchased, as per 49(1), it would have been his cost? No. Because now 5 lakh rupees is treated as his gift. So the stamp duty value of this property is treated as his income under the head IFOS. Now whenever Mr. A will sell this immobile property, what will be his cost of acquisition? This stamp duty value as per 49(4) later on. But right now this 5 lakh will be taxable for him. Yes or no? Cost to previous owner not to be taken. Period of holding of the previous owner not to be taken. Only stamp duty value will be taken as cost. Only his period will be taken as cost. That only we have done, no? Okay, next one. Mr. A purchased from his friend C, who is a dealer in a shares, 1000 shares of X Limited at 400 each on 19 June 2023. So he purchased 1000 shares in 19 June 2023. At what price he had purchased? 400. The fair market value of which was 600 each on that date. Mr. A sold these shares in the course of his business on 23rd June 2024. See, no, whatever stock in trade he bought, no, in 23-24 for 400, that stock in trade he is selling right now. At the time when he bought, the fair market value was 600. At that time he bought for 400. So friends, that time it was not taxed in his hands as gift, no. So can I say in the previous year 23-24 when he bought, that time the fair market value was 600. He bought it for 400. So 200 was the benefit on 1000 shares. Meaning that 2 lakh was the benefit. Don't you think that this 2 lakh was not treated as his income from other sources because 56 to 10 was not applied only? Now whenever he'll sell these shares right now, for how much? In the course of his business, he's selling right now. So whatever price he'll sell it, from that price, selling price, his 400 cost will be reduced. By the way, these shares did not come to him as his capital asset. So if he is going to sell these shares, his PGBP income will be calculated. To calculate that PGBP income, what will be the cost? The fair market value as on the date on which he got it? No, the actual cost at which he bought it. Done? So this entire information is given to calculate his PGBP income. Okay. Next one. Further, on 1st November 2024, Mr. A took possession of a property, office building, booked by him 2 years back at 20 lakhs. 2 years back he booked for 20 lakhs. Okay. So that time he did not give 20 lakhs. 2 years back he booked at 20 lakhs. The stamp duty value of the property as on the 1st November 2024 was 32 lakhs. Okay. And on the date of booking was 23 lakhs. He paid 1 lakh by account pay check, down payment on the date of booking. Yes. Now they are saying that as on the date of booking he paid. Now tell me, two dates are there. Date of booking is there and date of possession is there. Date of booking is 1st November and date of possession is later on. Okay, no? Okay, no. Possession date is 1st November. Date of possession is 1st November. Okay, no? 2024. And A took possession of the property booked by him 2 years back at 20 lakhs. Now, right now, he is getting the possession of the property. Right now, he is getting the possession. So, the stamp duty value of the property as on 1st November 2024 was 32 lakhs. And as on the date of booking 2 years back, at that time when he booked, okay, that time, what was the value? 23 lakh. So that time only, he has paid how much? 1 lakh rupees booking amount. He is not paying 1 lakh rupees booking amount right now. He has paid the booking amount that time only, 1 lakh rupees. Getting my point, everyone? See, the booking amount paid by him was, at that time the stamp duty value was 23 lakhs. 32 lakh is the stamp duty value right now at the time of taking the possession. The transfer is happening to him right now. But at the time when he booked, at that time only he has paid 1 lakh rupees by way of prescribed mode. So the stamp duty value as on the date of possession you will take, or the stamp duty value as on the date of booking you will take. Date of booking. That stamp duty value. And now see at how much you have acquired. 20 lakhs. And now since you are acquiring, taking the possession right now, no. So that 3 lakh benefit is happening to you right now. Getting my point? So whenever you will get the property, you will get the property right now. 1st November 24. How much? 20 lakhs you are saying you are buying for 20. Oh. Right now what was the stamp duty value? 32. So 32 minus, no, don't take 32. Take 23. The stamp duty value as on the date of booking. Yes. Because as on that day, you have already paid 1 lakh out of the consideration by way of prescribed modes. So that stamp duty value will be considered to determine the value of your gift. So tell me, 20 lakhs minus 23 minus 20, 3 lakh rupees difference. This 3 lakh rupees difference is more than 10% of 20 lakhs, more than 2 lakhs. Hence the entire difference you have to check. 2 lakh rupees you have to check whether it is more than 50, whether it is more than 2 lakhs. No, whether it is more than 2 lakhs. So difference of 3 lakh is more than 2 lakhs, no. So this value of 3 lakhs will be taxable to him as his gift. Got it, sir? So they are saying on March 1st, 2025, he sold the plot of land at Faridabad. See, the plot which he acquired from his friend. Do you remember this one? Okay. He is selling it for how much? 7 lakhs. Can I say capital gain will be calculated here? So to calculate the capital gain, full value of consideration 7 lakhs, yes or no? Minus transfer expense, nothing. Net consideration 7 lakhs. What will be the cost of acquisition? 49,400. The entire 5 lakh stamp duty value of this plot charged under the head IFOS will now be taken as your cost of acquisition. So 7 lakh minus 5 lakh. 2 lakh will be your short term gain. Why short term gain? Because you acquired in 1st July and you transferred in 1st March. Period of holding is less than 24 months. Short term gain. To calculate short term gain, what will be the cost? As per 49,400, 5 lakh rupees. Mark this question important. Good question this is. This is testing all the knowledge which you are having for gift provisions. Yes or no, sir? Now what they are saying, compute the income of Mr. A chargeable under the head IFOS. Now what income will be chargeable under the head IFOS? Come on, tell me. See, looking at this thing, we can say that this amount will be chargeable 75,000. This 60,000 will also be chargeable. And can I say this 5 lakh will also be chargeable under the head IFOS? So 5 lakh plus 60,000 plus 75,000. This amount will be chargeable under the head PGBP. This is nothing to do with IFOS head. This is deliberately given to confuse you. Okay? Deliberately given to confuse you. Nothing to do with your IFOS head. Because the shares which you are acquiring in the form of stock in trade. And on that, whatever benefit is happening is not happening right now. It happened last year. And last year, that was not taxed as your gift. So this year also will not be taxed as gift. Whenever you will sell the shares as your stock in trade, that time the PGBP income will arise. So whatever gain happening at the time of acquisition will be automatically taxed in the form of PGBP income. Yes or no? So there is no IFOS income arising last year also and in this year also for this transaction. Okay. Next one. Here there is 3 lakh rupees of IFOS income. So can I say 5 lakh here, 60,000 here, 75,000 here and 3 lakh rupees here. So 5 lakhs plus 3 lakhs plus 60,000 plus 75,000. Can you have 9 lakh 35,000? That 9 lakh 35,000 is your IFOS. Can you see this? Now you just have to write sum of money received without consideration since the amount is more than 50, entire amount taxable, outer column taxable. Asset received without consideration, fair market value is more than 50, entire amount taxable. So immobile property whose stamp duty value was more than 50,000 received without consideration, entire value taxable. Immobile property purchased for a consideration which is less than the stamp duty value. Take the stamp duty value 23 lakhs. Purchased for 20 lakhs. The difference between the stamp duty value and the consideration 3 lakhs which is more than 50, no, more than 10%. Hence that entire difference is also treated as what? Gift taxable under the head IFOS. You just have to write down this in particulars and write down the amount. That's it. Will you be able to do it? And they are telling you to calculate what? One more thing. And capital gains also. So the capital gain arising on transfer of this plot of land which came to you as a gift. So the asset which came to you as a gift for which 56(2)(10) provisions got applied. So for that asset, whatever stamp duty value, whatever fair market value which you took for determining your gift taxable under IFOS, that stamp duty value, that fair market value of that asset will be deemed to be the cost of that asset as per 49(4). So whenever that asset will be sold in future, to calculate the capital gain, cost will be as per 49(4). Cost will be stamp duty value or the fair market value taken for gift purposes. Hello? That only you have taken. See here. 7 minus 5, 2 lakh will be capital gain and the gain will be short term. Why the gain will be short term? Because you acquired in July and you transferred in March 25. That's it. Period of holding is less than 24 months. Will you be able to do it? Sure? Very good. Now pay attention. This one. Illustration number 3. Discuss the taxability of otherwise of the following in the hands of recipient under section 56(2)(10). Recipient you have to think. So do the same markings which I have done in your question also. Same markings you are supposed to do. Akhil HUF received 75,000 in cash from niece of Akhil. That is daughter of Akhil's sister. Akhil is Karta of the HUF. See, Karta of the HUF, his wife, his children will be the member of the HUF. My sister is not member of my HUF. and neither her daughter is the member of my HUF. My sister is married to my brother-in-law. She is the member of that HUF. My sister's daughter, who is my niece, is the member of her father's HUF and not my HUF. Am I receiving the gift in the capacity of an uncle? No. Even if I would have received the gift in the capacity of an uncle, no, still that gift would have been taxable for me. Because for my niece, I am her mother's brother, parents' brother. For her, I am her relative. But for me, she is not my relative. But I am not getting the gift in my individual capacity. I am getting the gift in the capacity of HUF. HUF is getting the gift from a person who is not the member of the HUF. So this niece of Akhil is not the member of the HUF. Hence, she is not the relative for the HUF. Hello? So HUF is getting a gift from a relative or a non-relative? Non-relative. How much is the amount of gift? 75,000, more than 50. Entire 75,000 taxable for HUF. Hello? Will you remember? Next one. Nishita, a member of her father's HUF. Nishita is the member of her father's HUF. Very good. Transferred a house property to HUF without consideration. The stamp duty value of the house property is 9 lakh rupees. Now who is getting the gift? HUF only getting the gift. Now the HUF is getting the gift from the member, meaning relative. So whatever may be the amount of that gift will not be taxable because it is coming from the relative. Hello sir? Will you remember sir? Next one. Mr. Akshat received 100 shares of A Limited from his friend. Friend is not a relative. So from a non-relative, if you are getting shares, specified movable asset, and your business is not dealing in shares, so for you the shares are capital asset. Yes or no? 100 shares as a gift on the occasion of his 25th marriage anniversary. Marriage anniversary gift taxable, huh? Provided the value is more than 50. So what is the value of the shares? Value of the shares is 100 per share. 100 into 100 will be 10,000 only, sir. The fair market value of the shares is 10,000 only. Not taxable, sir. But wait. If that is the only gift received during the previous year, then the aggregate is 10,000, not more than 50. But during the previous year, he is getting one more gift. Gift of what? Jewelry worth 45,000 from his nephew. If I give him for him, it is not taxable because for him, I am his relative. But if he gives me, he is not my relative. For me, my brothers and my sisters, children are not my relatives. So if they are giving me any gift, will it be taxable for me? Yes, absolutely. Provided the value is more than 50. Now during the previous year, you are getting two gifts from non-relative. Both the gifts amount is 10,000 and 45,000. The total amount is 55,000. Aggregate is more than 50. Entire 55 will be taxable. Yes or no? Now, son of Karta is getting the gift from HUF. Karta's son is the member in the HUF. Hello? So, member is getting the gift from HUF. For HUF, member is a relative. So, for member, HUF is also a relative, no? So, son of Karta is what? Recipient. Getting the gift from HUF. From relative only. So, this gift is not taxable because it is coming from relative. And number two, the asset which is gifted is car, not a specified movable asset. So, whatever may be the value, the gift will not be taxable. What if it was jewelry? Then also it was not taxable because it is coming from relative. So, two reasons. One, coming from HUF, meaning coming from relative. Number two, the asset is also not a specified asset. Hence, both the reasons are sufficient to not charge this amount under the head IFOS. Yes or no? Illustration number 4. Mark this question important. Mr. Hari, a property dealer. See, for this property dealer, his properties are stock in trade. For this property dealer, properties are stock in trade. Okay, no? Sold a building means he is selling a stock in trade. In the course of his business to his friend, Mr. Rajesh. who is a dealer in automobile spare parts. So for Rajesh, the building is not his stock in trade, because Rajesh is doing a business of automobile spare parts. So Rajesh is taking that building as a capital asset. Rajesh is purchasing as a capital asset, and Hari is selling as a stock in trade. What? Building, immovable property. Now, how much is the sale consideration? 90. Now, if I write H and if I write R, Hari is selling his stock in trade, and Rajesh, who is not a dealer of property, he is dealer of automobile spare part, he is taking the property as his capital asset. Yes or no? Now the property is sold by Hari to Rajesh for 90 lakhs. 90 lakhs is the selling price. Okay, no? On 1st of January 2025, when the stamp duty value was 150 lakhs. The agreement was, however, entered into on 1st of September 2024. Meaning the sale happened on 1st of January 25, but the sale agreement got entered prior to that on 1st September 24. And as on the date of sale agreement, the stamp duty value was only 140. Now you have two stamp duty values. One is as on the date of sale agreement, and another as on the date of registration, as on the date of sale. Which stamp duty value you will take? Always 150. But if the consideration 90 lakhs or any part thereof is paid by way of prescribed modes on or before 1st September, then you will ignore 150 and you will take 140. Everyone. So, Mr. Hari had received down payment of 15 lakhs by crossed check from Rajesh on the date of agreement. By the way, crossed check is not a prescribed modes, friends. It is a crossed check. Account pay check is a prescribed mode. Meaning that as on 1st September, what did I say? As on 1st September, as on the date of sale agreement, is the consideration received? Yes, but it is not received by prescribed mode. So the stamp duty value as on the date of sale agreement cannot be taken. The stamp duty value as on the date of sale, 150 lakhs, that will be taken. Getting my point? Now tell me, 90 lakh is the sale price and 150 lakhs is what? Stamp duty value. Now for Hari, who is selling it as a stock in trade, can I say stock in trade is sold for a stamp duty, sold for a consideration which is 90 lakhs. Stock in trade is sold for a consideration which is 90 lakh, which is less than the stamp duty value 150 lakhs. Stamp duty value is more as compared to the selling price, and the difference between both of them 60 lakhs is more than 10% of 90 lakhs. 43 CA will apply, and as per 43 CA, Hari will show 150 as his PGBP income. Hari will have to show 150 lakhs as his PGBP income and not 90 lakhs. And don't you think for Rajesh, Hari is not his relative, and Rajesh is taking the asset as a capital asset? For Rajesh, 56 subsection 2 clause 10 will be applicable, gift provisions will be applicable. So under the gift provision, he is buying an immobile property for a consideration which is less than its stamp duty value, and the difference between both of them is 60 lakhs. Is this difference more than 50 or more than 10%? Whichever is higher, more than 10%, no. So for him, that 60 lakhs will be treated as his income from other sources. This is the effect which they want you to discuss. This entire thing is given here in 2 pages. And just see how easily you have done it. This is the magic of Umang sir. Say thank you. Say thank you. But wait. In that same question, no, they are telling you, discuss the tax implications in the hands of Hari and Rajesh, which we have discussed. Assuming that Mr. Hari had purchased the building for 75 lakhs on 12th July 2023. Wait, he has purchased on 12th July 23 and he has sold on 1st January 25. The period of holding you don't have to see only. Why? Because he is selling as stock in trade. So for stock in trade, you don't see period of holding. What will be the PGBP income? 150 minus 75 lakhs will be his cost of stock in trade. So 75 lakhs. Here you will reduce 75 lakhs. So what will be his PGBP income? 75 lakhs will be taxable for him under the PGBP. And for Rajesh, 60 lakhs will be his. 60 lakhs will be his IFRS income, gift income. Now, in the same question they are saying, would your answer be different if Hari was a share broker instead of property dealer? Absolutely, my answer would have been different. Now the Hari is not selling the asset as a stock in trade, he is selling the asset as his capital asset. So 43 CA will not be applicable, 50 C will be applicable. So this 150 lakh is still taxable for him as his full value of consideration to calculate his capital gain. And now his capital gain will be short-term capital gain amounting to 75 lakhs. Why? Because he acquired the property on 1st of July, 12th July 23 and he transferred on 1st January 25. The period of holding of this capital asset of Hari was less than 24 months. So the short-term gain will be calculated. To calculate that short-term gain, 150 will be taken as full value of consideration as per 50C now. Will you remember this? Easy, no? Now this entire story, no, which I have explained is given here. Today you are sitting at home and reading this entire story. Huh? You don't have to write this answer like this. Okay? No need to write down all these stories. Just write down in a manner, presenting in a way in which we are presenting. Hari, Rajesh. Hari, what is doing? Rajesh, what he is doing and what is the tax treatment. That's it. No need to write down all these things. The same thing which we have done, no? You're supposed to do it like that only. Will you be able to do it? Sure, everyone? Next question. See, 60 lakhs here, 75 lakhs here, 60 lakhs here, 75 lakhs here, and this is 43 CA. Now here it is 50C. The same thing which we have discussed. Understanding? Next one. See, this is a theory. Theory on 1010 BC. There is one exemption given under 1010 BC. Okay. I will first explain that 1010 BC, then you are going to read this. That's it. See, whenever a disaster takes place, disaster can be a natural disaster or it can be a man-made disaster. Just now, few days back, last week only, one disaster has taken place. If you would have heard about cloud burst in Uttarakhand, the entire village got washed away. Did you see that video of that? The cloud burst. The entire water in the cloud came down and it wiped away the entire village. So many people died, so many things got wiped out. So that is a disaster, no? Last month, one plane got crashed in Ahmedabad. That is also a disaster. So whenever some disaster happens, no, there is a loss of life, there is a loss of, normalcy. What happens in that case? Somebody has lost the life. So their family members will get the compensation. Or somebody became incapacitated. Incapacitated means handicap, etc. So they will get the compensation. So as a result of disaster, some loss is happening. To compensate for that loss of life, the family members will be given some amount, or loss of hands, legs, becoming handicapped. Okay, no? So to compensate for that loss, some amount is given as a compensation. Who is going to give that amount? Either central government or state government or a local authority. So any compensation on disaster received by any person from government or a local authority, fully exempt under 1010 BC. Will you remember? But wait, sometimes the loss which has happened, you have already claimed that loss as a deduction under Income Tax Act. Possible, no? You are running a business and as a disaster in that business some loss happened. your entire stock got washed away. So that stock which got washed away, that was a loss happening in the business. You claimed it as a deduction under the head PGBP. And now against that, if you are getting any compensation, you cannot claim that compensation as exempt under 1010BC. Now you'll have to show that amount as your deemed PGBP income, because that is coming against a loss which you have already claimed as a deduction under the Income Tax Act. Hello sir. So any compensation coming for a loss which is already allowed as a deduction under the Income Tax Act, against that, whatever compensation you will be receiving, that will not be exempt. That will be your deemed PGBP income. Yes or no? But if it is coming from central government, state government or any local authority to any person who has lost the life, or to his family members, yes or no, who has become handicapped, to that person or his family members on his death, then that compensation on disaster is fully exempt. Okay, will you remember this? Read this at your home. Okay, so correct or incorrect, you have to show this. Examine under which head the following incomes are taxable. First, rental income in case of property held as stock in trade. So even if the property is held as a stock in trade, the rental income will be taxable under the head house property. Okay, no? Second one, salary received by the partner from the partnership firm, PGBP. To the extent it is allowed to the firm, to that extent it is partners PGBP income. Specific charge is there, if you remember. Okay, next one, rental income from machinery. It will be either PGBP or it will be IFOS. If not taxable under the PGBP, then it will be IFOS. Okay. Then winnings from lottery by a person having the same as business activity. So even if you are having this activity as your business activity, but under the Income Tax Act, it is not treated as business. So accordingly, even if you perform this activity on a regular basis or sometime, whenever you are getting some winnings income, that is always taxable under the head IFOS. Okay, no? Next one. Salaries received by the Member of Parliament. Salaries of MP, MLA, MLC taxable under the head IFOS. Next one. Receipt without consideration, meaning gift. It will always be taxable under the head IFOS. In case of retirement, interest on employees' contribution if PF is unrecognized. See, if there is unrecognized provident fund and the lump sum amount is coming to you, we bifurcate that lump sum amount into 4 parts, if you remember. Employees' contribution coming back is not your income, ignore that. Interest on employees' contribution taxable under the head IFOS, and employer's contribution and interest thereon will be taxable under the head salary as profit in lieu of salary. That we have already done with salary head. Okay, now? Next one. Rental income in case of a person engaged in the business of letting out of commercial properties. This will be PGBP. But if the business is to let out residential property, then explanation 3 to section 28 is inserted with effect from this year. Then that rental income cannot be treated as PGBP. Then it has to be income from house property. Yes or no? But this we will consider as PGBP. Did you get all the incomes correctly? Okay. Classification was okay, no? Okay, perfect. Now, coming to point number 2. Question number 2. Examine whether the following are chargeable to tax and amount liable to tax. And the amount liable to tax. Whether it is chargeable. If yes, then tell me how much amount will be taxable. First one, sum of 1,20,000 was received as gift from non-relative by Raj on the occasion of marriage of his son Praveen. So on the marriage of the son, if the son is getting something, then it is not taxable for the son. But if you are getting anything, it will be taxable for you because it was not your marriage. Okay. And if non-relatives are giving it, then it will be fully taxable. How much? 1,20,000 fully taxable. Yes or no? Next one, interest on enhanced compensation. The moment you will see the entire amount, that entire amount will be taxable on receipt basis. No matter to which year it will be taxable. But you are going to get a 50% standard deduction out of this. So out of 96,000, you take a 50% standard deduction, your IFOS income will be 48,000. Hello sir. You got these 2 points? Easy, no? Answer was easy. Did you solve these questions? Sure, no? Next one. Now, on 10th of October 2024, Mr. Govind, a bank employee, received rupees 5 lakh towards interest on enhanced compensation from state government in respect of compulsory acquisition of his land, effected during the financial year 2016-17. So in 16-17, what happened? The compulsory acquisition took place. But the compensation for that you are receiving in 2024-25. On 10th October, you are getting that compensation. Hello, sir. And the compensation was rupees 5 lakhs. So tell me, that entire 5 lakhs will be taxable under the head IFS. You are getting interest. You are getting interest of rupees 5 lakhs. That interest will be taxable. The compensation is taxable under the head capital gain, but the interest on that compensation will be taxable under the head IFS. 5 lakh entirely taxable here. Okay, no? Now, out of that 5 lakh, you will take 50% standard deduction. 2 lakh 50 will be your IFS income. Yes or no? Now, out of this interest, 150 relates to the financial year 17-18, 165 to the financial year 18-19, and 185 to the financial year 19-20. Forget about that. The entire interest received in this year will be taxable in this year. It is always taxable on receipt basis. He incurred 50,000 by way of legal expenses to receive interest on such enhanced compensation. This is his legal expense. So do you remember that when we calculate the capital gain, and at that time when we receive the enhanced compensation, out of that enhanced compensation we already get the deduction for this legal expenses. So this you would have already claimed as a deduction under the head capital gain from the enhanced compensation amount. And you cannot claim it as a deduction from here, from the interest amount. Yes or no? From interest we are giving you 50% standard deduction. No, that is sufficient. That will take care of everything. But this litigation expense or the legal expense which you have incurred to get the enhanced compensation, this will not be allowed as a deduction from your interest. This will be allowed under the head capital gains out of the amount of enhanced compensation. Yes or no? So, how much of the interest on enhanced compensation would be chargeable to tax? 2 lakh 50. That's it. Done now? Next one. Fourth one. Following details have been furnished by Mrs. Hemali pertaining to the year ended 31st March 2025. This question I gave you to solve at home. Okay, did you try? Let's see. Cash gift of 51,000 received from her friend. Friend is not a relative. So from a non-relative you are getting a sum of money more than 50,000. This entire amount will be taxable. And this was received on the occasion of Shashtipata Purti. Okay. So what is this? This is a function which we normally keep when the husband attains the age of 60 years. Yes or no? So that time a marriage like celebration takes place. So marriage like celebration takes place. It is not the marriage. Okay. And on that occasion, if you are getting anything that you are not receiving at the time of marriage, so the gift will be taxable because the amount is more than 50 and the amount is received from a non-relative. The entire gift will be taxable. Yes or no? Now, on the above occasion, a diamond necklace worth rupees 2 lakh was presented by her sister living in Dubai. So I don't know wherever the sister resides, but is she my sister? Yes. Is she my relative? Yes. So from relative, whatever gift I get, whatever amount, will it be taxable? The answer is no. It will not be taxable, whatever may be the amount. Yes or no? So that will not be taxable. When she celebrated her daughter's wedding on 21st February 2025, her friend assigned in Mrs. Hemali's favor a fixed deposit. Again, friend. Friend is not a relative. So from a non-relative, you are getting what? Fixed deposit. See, friends, fixed deposit is as good as cash only. As good as sum of money only. So if you are getting sum of money and the amount of that sum of money is more than 50,000 and that amount you are not receiving on the occasion of your marriage, you are receiving on the occasion of your daughter's marriage, and you are receiving not from a relative, you are receiving it from a non-relative. So this 52,000 will also be taxable. Yes or no? Value of the fixed deposit and the accrued interest, including that interest, is 52. So in all, total, you are getting how much? 52,000 rupees sum of money. That entire 52 will be taxable as your gift. So how much is the total taxable income from other sources? 51,000 plus 52,000, it will be 1,03,000. Done, sir? Everyone? Now coming to question number 5. This is the last question. Okay. Examine the following transactions in the context of Income Tax Act 1961. Mr. B transferred 500 shares of R Private Limited to Messrs. B Company Private Limited on 10th of October 2024 for rupees 3 lakh when the fair market value was 5 lakh. The index cost of acquisition of the shares for Mr. B was computed at 4 lakh 45,000. The transfer was not subjected to STT. Determine the income chargeable to tax in the hands of Mr. B and Messrs. B Company Private Limited because of the above said transaction. This is a good question. Mark it important. This part is important. This I am going to discuss. Give me 2 minutes. First, let us complete the second part. Mr. Chazian is employed in a company with a taxable salary income of rupees 5 lakhs. He received a sum of rupees 1 lakh from Atma Charitable Trust registered under section 12AB by account paycheck in December 24 for meeting his medical expenses. If you get something from HUTLO, do you remember? H for hospitals, medical institutions, U for universities, educational institutions, T for trusts or charitable institution. So from any trust or charitable institution also, whatever you receive or whatever you give them, that is not treated as gift under the gift provision. Yes or no? So you are receiving something from a charitable trust as a help. How can we consider that as your gift? Even if the amount is more than 50,000, that amount will not be taxable under the gift provisions. Yes or no? Because it is covered by the exceptions. Will you remember this? Now the first part, see, very easy, very easy. What you are supposed to do? This is Mr. B. Okay. And B Company Private Limited. Messrs. B Company Private Limited. So now what Mr. B is doing? Mr. B is selling the shares. Okay. Shares of R Private Limited. Shares of R Private Limited transferred for rupees 3 lakhs. So the consideration is 3 lakh rupees. Is Mr. B transferring his capital asset or he is transferring his stock in trade? Mr. B is in the business of share trading. Mr. B is in the business of share trading. Is it given anywhere? Meaning that shares transferred by him is not his stock in trade. Shares transferred by him is his capital asset. So he is transferring his capital asset. To whom it is transferred? B Company Private Limited. B Company Private Limited is in the business of trading in shares. Is it given anywhere? Meaning the shares are not received by B Company Private Limited as stock in trade. Even the B Company Private Limited is getting the shares as what? Capital asset only. So the transferor is transferring as capital asset and the recipient is getting it as a capital asset. Okay, now. So for the transferor, Mr. B, don't you think capital gain would arise? Because Mr. B is transferring his capital asset for how much? 3 lakhs. So the consideration for transfer is 3 lakhs. But the fair market value as on the date of transfer was 5 lakhs. Meaning that the shares are transferred for a value which is less than its fair market value. And the shares are not listed shares. Shares are other than quoted shares. And for the shares which are not quoted, unquoted shares, if the fair market value is more than the sale consideration, then 50 CA will apply and the sale consideration will be ignored and the fair market value will be deemed to be the full value of consideration. Do you remember 50 CA? So 50 CA will be applicable here. Okay. Now taking 50 CA, taking that fair market value as full value of consideration, the capital gain for Mr. B will be calculated. Yes or no? Now tell me one thing, capital gain calculation, full value of consideration will be how much? Fair market value as on date of sale, which is rupees 5 lakhs, and this you have taken under section 50 CA. Will you remember this? Less transfer expense, that is nil. So the net consideration will be 5 lakh. Now you will have to first see the period of holding of the shares in the hands of Mr. B. Based on that period, it will be decided whether the shares are short term or long term. And if the shares are short term, cost will be reduced. If the shares are long term, index cost will be reduced, provided the shares are transferred on or after, prior to 23rd July. But see, in this question, no, there is a drafting mistake, I will tell you. What mistake is there? Mr. B has transferred 500 shares on what date? Can you see the date? This is the date of transfer. And if this date is on or after 23rd July, whatever may be the period of holding, even if the asset is long term, yes or no, indexation will not be given. But see, in the question what they have written, index cost of acquisition to B was 4,45,000. So either you should have given the date of transfer prior to 23rd July, or you should have, if you want to keep that same date, ignore the word indexed. The shares cost of acquisition cannot be indexed, yes or no? And if you are saying that this is index cost, then tell us when the shares were acquired. We'll do the reverse calculation and we'll calculate the cost of acquisition. Even that can be given in the question. If the shares were acquired in 2008-9 and the transfer is happening in 2024-25 and this index cost is given, meaning the cost was not this much, cost was something else. So that we will calculate by doing reverse calculation. Into 363 divided by CII of 2009-10 we would have done, no, we would have done it reverse and we would have got the value, cost. But to that extent they will not go, don't worry. Okay, but if that was the case, even that could have been done in the question. But see, here the word used, index cost of acquisition, is wrong. It is cost of acquisition only. Okay, so take this 4,45,000 as cost of acquisition. That is 4,45,000. So 5 lakh minus 4,45,000. 55,000 will be the capital gain. Now what is the nature of this gain? Long term or short term? When did B acquire the shares? Nothing mentioned, they are saying index cost, no. So it is long term only. Okay, no. So this will be the long term capital gain on transfer of shares, which will be taxable under 112A. No. It would have been 112A if STT was paid and it was transferred through recognized stock exchange. Yes or no? But this will not be taxable under 112A. This will be taxable under 112 unlisted shares. Done, sir? So this long term gain 112 amount is 55,000. This will be taxable in the hands of B. Now if I talk about B Company Private Limited. B Company Private Limited receiving the asset from Mr. B. Relative, non-relative? No. No relative is there in the case of a company. Yes or no? So for company, definitely section 56, subsection 2, clause 10, gift provisions gets attracted. And under the head income from other sources, what the company will have to do? 5 lakh minus 3 lakhs. The amount is 2 lakhs. That 2 lakhs will be taxable in the hands of the company. Okay. Now think one step ahead. What if the company, if the above shares, if the above shares transferred by B company private limited, then that time capital gain would be computed in the hands of B company. Now what if B company would have taken the asset as stock in trade? Then this IFOS 2 lakh was not taxable for B company because it is taken as stock in trade. Then in that case, whenever B company will sell in future, it will be sold as what? Stock in trade. That time the 3 lakh rupees cost will be taken as cost of stock in trade. So the amount of gain which is taxable here right now, 2 lakh, would have been taxed as what? PGBP. But since it is taken as since this is taken as capital asset, hence the provisions of gift are already getting applied. Yes or no? And 2 lakh rupees is getting taxed in the hands of company right now only. Now this 2 lakh should not be taxed again. So for that, whenever the company will sell the asset as what? Capital asset, that time we'll have to take 49.4 as cost of acquisition. Now in the question, are they telling you that the company is selling the shares in the future? No. If the company would have sold, capital gain would have been calculated in the hands of company, and that time to calculate the capital gain, cost of acquisition would have been 49.4. That is nothing but the fair market value considered under section 56 subsection 2 clause 10 to determine the value of gift. Yes or no? And that was how much? That was rupees 5 lakhs. That would have been the cost of acquisition of these shares in the hands of company. Will you be able to solve a question like this in the exam? If this type of question will come, no, it will be for minimum 4 to 6 marks. Minimum 4 to 6 marks. Or a case study can also be created. Sure, sir. Did you copy this? Did you copy this? Sure. Should I move ahead? Okay. So this was your last question. Question number 5. And with this we have completed all the questions of income from other sources, and the chapter is over now. Okay.